What a week, what a week, what a weekend. We're here, we're back. Powell is starting to confirm. Powell is confirming weakness in the economy, weakness in the consumer, weakness in the jobs report. Yes, as I shoot this video, retail sales came in a little bit higher, but let's be honest, folks. You know what I know, nobody is spending the money and buying stuff like they did coming out of the pandemic. They're just not. Nobody's hiring as much. Nobody's wages are growing as faster. Inflation is coming down. Powell is clearly seeing the weakness in the economy. He's acknowledging it. Also, he did confirm that, hey, I'm not going to wait until we get to 2% because then it's too late. So he's well aware the market fundamentals, the weaknesses, the holes, and how if he waits too long that he could cause unnecessary job loss, unnecessary, longer, tougher, wider, deeper recession. So he's got to be very careful when he starts the rate cut, and also how he does it. He has to be very careful how he talks, he says. He got grilled last week by Congress. I posted one of the clips about the jobs market and how he got grilled by one of the Congress people that saying, you do realize that 75% of these jobs are health, government, and what if the government doesn't spend? Then we know there's definitely weakness in the jobs market. So when you start really looking at everything, we're clearly seeing the weakness. And obviously we have election coming up here, and politically things are just crazy. But economically, consumer, you're still spending, you still are employed, and you have that money to pay those bills. So even though your credit cards are racked up, you're barely surviving. The middle to lower class is just holding on with if they're renting, with the cost of gas, food, electricity, all that stuff, insurance. It's out of control. And honestly, I hope we do have a little bit of correction or something to bring those prices down, to make it more reasonable for all of us with those necessities that we have to buy. There's many reports coming out that are really diving into what people are buying and stuff. And I've heard stuff where people are definitely cutting back on groceries. I've heard where people are not buying as much groceries, or when they go out and eat, they're sharing, or they're being very selective of feel-good items. Like, I'd rather get my nails done than rather go buy that extra food I need in my house. I just don't need that crap. Literally, the people that study consumers, the credit card information, the data, they are clearly seeing since the pandemic, we are kind of a feel-good thing. That's why you're seeing people still travel to those experiences, right? Those are still full in effect because that is what we want. We'd rather cut and say, I won't go out and eat, but I want to go travel, or I want to go get my nails done, or go to that barber, or go do that thing, but I'm willing to cut over here and not do this. So that is what we're seeing in the market. And look, remember, as things slow down, as we enter into a landing, soft landing, hard landing, whatever it is, as we get closer to this election, things are going to continue to change, unravel, keep watching the data. But as we do this, hopefully we're starting to see those rates come down. We're starting to see that spread get better. The 10-year treasury it just goes under 4.20, then goes above and under. So we haven't hit that threshold line. The data hasn't said signal enough to be like, let's fly down and start chasing 4. But if we go to the 4, rates will get better. So spreads between the 10-year and the 30-year fix have gotten much better. I think they're about 70 basis points better than this time last year. So rates could technically be worse. So we should be happy about that, because the 10-year treasury is at 4.20, I think, as I speak right now. So all this stuff, all this data consumed. Welcome back, everybody. My name is Kenny Simpson. If it's your first time here, welcome. If you've been here over and over, I appreciate you guys. Again, my name is Kenny Simpson. I focus on 1 to 4 unit financing. I've been doing that for about 20 years, helped over 5,000 clients, funded billions of dollars of loans, and I'm here to help and serve you with any needs you may have. So if you wanted to reach out, connect with me, jump on a call, answer any questions, let me look over anything you're maybe have a pre-approval, or you have a loan quote from somebody else and you just need advice, please, in the description below, hit me up, schedule an appointment, call me, text me, schedule a Zoom, schedule a call. Love to chat with you. And if it's your first time here, then thanks for watching. Obviously, this is where I go through week over week, putting out the content of what's going on and kind of what's going on nationally, maybe, worldwide, that's going to affect rates, market, real estate, things like that. And we look at consumer spending. We have some fun stuff, some fun articles I bring in. So enjoy. Appreciate you watching. Please share this with somebody. Like, subscribe, comment. I love all that stuff. Anyways, without further ado, for the people that are first here, you don't know what's next. For the people that have been here week after week, which I do appreciate, what is next? It's inventory. So what is going on with inventory? Because what is the number one problem we're having? We are having a recession in real estate. That is because there is no transaction. And if you're talking about real estate, we're talking 1 to 4. Because if you're talking about the commercial market, that is a utter depression because that is way down. So we just don't have, when we say real estate recession, it doesn't mean home prices are falling off a cliff and they're going to crash. It means that where there's just no transactions, that everybody has this locked in effect in these interest rates. And speaking of lock-in effect interest rates, what's amazing about it is that I was actually out of town this weekend, and just when you talk to people, I was at a wedding, you're talking to people, what do you do? I'm in real estate, I'm talking to people, just in life. And every day I talk to people, it is the same. I don't care what level it is, it's the same thing. Why would I give up this rate, this payment to go do this? Why? So this is what's happening across the board is people are stuck. They feel stuck in their house because they'd rather go from the 2-story to the 1-story, but they're not going to give up the rate. And I said, you know what? It's not the rate you're giving up. It's the payment. It's exactly what I said, because if I was offering a 0% interest rate, and you're going to go buy that house and you can't afford the payment, what does it matter what the rate is? All you care about at the end of the day is, can I make that payment? That is what we care about. So the payment, that is the lock-in effect that trumps your equity you have, or what you bought the house for, or what your rate is, because it really comes down to payment. You do not want to give that up. You are not willing to sell the house and go buy something else that's going to be more, because it makes zero sense. So that locked-in effect is real. That is what people are focused on, and that is where people are trapped and they're not going anywhere. And they might go, hey, we might be here forever. We might never move because of what is going on. So let's check out the data for this week. Nationally, inventory, 651,000. Last week, it was about flat. So there's no inventory. And the reason what we're going to blame is 4th of July. We're going to go ahead and blame 4th of July and say, hey, it's a dead week. So hopefully this picks back up. But 651,000 for nationally, week over week, is terrible, my friends. It's not good. But it's better than where we were in 21, in 22, and 23, and so on. So it was much worse back then. It's much better now. We still need to get at least double this number, if not more, quickly. But you and I know it ain't going to happen because what I just talked about a minute ago. What's going on in San Diego? If you're new, I always go over San Diego because it's where I'm located. San Diego, new listing 643. That is up. Listing sold 380. And active listings is 4,600. Last week it was 4,047. I looked last year. We're still beating last year. So we're doing good. We're up, just not enough in enough places, because there's certain parts of San Diego where it's very, very popular, schools, you want to live, and it's just, there's no inventory. So when a house comes up, it's a bidding war. Somebody's overpaying, and that's just the name of the game, and that's what we got to deal with. How are we looking at mortgage rates? What is going on with mortgage rates? Well, we are stuck at this 420 level. As I just looked before I shot this video, this morning we were down a little bit, went up to 420. That's because retail sales came in a little bit hotter than expected, but I'm throwing that out the window because I can know the consumer is hurting. So I'm not going to sit here and worry about retail sales, of digesting it, because I'm sure it's something to do with some inflated thing, and that's why they're higher. But regardless, like I said, I wouldn't be surprised if people are consuming more in the summer, buying back to school crap, shopping, doing more stuff, because that's what you do. So if it's higher, fine. But mortgage rates, yes, they went a little higher, went a little lower. It's just going to be a slow race to these 5%, which I think we will land based on the spreads coming down and the 10-year coming down. But that's going to take time. Could it go faster? Sure, but the data would have to show it. And speaking of data, what economic data are we looking at this week? What is going on? Yes, there's Fed officials talking. It's a big week. We got the manufacturing survey. We got retail sales I just talked about, import prices, inventories, home builder confidence, housing starts, building permits, Fed president's talk. We like weeks like this with a ton of data because it helps get the data out, get to understand what's going on, so that way we can make informed decisions about rate locks, not locking, or what do we think is going forward. This also helps Powell understand the data to see if he's closer to a rate cut. So data weeks where it's coming out, that's good. The news we want is continuing inflation to come down. We do want the consumer kind of easing still where they're not spending out of control, which is happening. The jobs market, we don't want people to lose jobs, but inevitably they will. And Powell needs them to. So we are going to eventually have where people are going to lose jobs. And, people are losing good jobs. I have clients that are. I'm sure you know people that are. I have friends that are. So they have to go find a new job. So it's definitely tough out there in some sectors of the market because, for example, if you're a software engineer or something like that, it's hard to go find a job because they've cut back a lot of these companies, these tech companies. So that is all the data for this week. We'll continue to watch it, report on what comes out this week for next week. So there's the data. There's catching up on what's going on with inventory rates and data for the week. Why do we care about that, folks? Because here on this channel, we like to look at the data and we don't like to talk about doom and gloom and hypothetical and all that crap. We really don't want to predict things, although I'd say as rates eventually will come down over time, it's just going to get there because predicting things is really hard as data changes. It's challenging and we're in unprecedented times with the deficits we have, with the political game, with how much money we printed, with 2 wars, obviously people trapped in homes because of the rates. And so a lot of uncertainty out there and many different things. So it's very hard to predict things. So that's why we keep watching the data day after day, week after week, month after month, and we just report on the data and we find what's happening. As you guys can see, where the data tells us what economy, market, inflation, all that's getting weaker, good. Interest rates are slowly but surely going to come down. Housing inventory is getting better, but it's still not good enough. And nobody really has a good answer of how they're going to get out of housing, especially the government. Because I know people say they're going to build 2 million homes and all this. Great. The problem with that is it's going to take you 5 years to do that if you can do that. And we need those now, not in 5 years. So you cannot build fast enough to get this inventory out there. And we have millennials and the Gen Z and all these, these up and coming youngsters that are going to date, mate, get married, have kids, have jobs, buy houses, buy condos, house hack, whatever it is. And they don't know how they're going to do that, how they can afford it. And I was talking to people this weekend about that, like, buying in a place like here, San Diego, California. A lot of people here have help from family, friends. They get the down payment. So it's tough. It's very, very tough out there to make things work. And so with that being said, you got to be creative. In an environment like California, San Diego, you have to be creative. Other environments, you don't have to be as creative. There's houses that are more affordable. The affordability level is better. But still, we're all dealing with higher energy prices, higher insurance prices, higher gas prices, higher food costs when you go out to eat. We're all dealing with this inflation problem, so that does not help. And, when you're buying a home, the cost of insurance is definitely a lot more. And then with the interest rate, so affordability is at the all-time low right now, which is not good. And, we need to try to fix that. And how do we get out of this mess of getting more inventory and getting more people to buy homes? Is obviously lower interest rates will definitely help. And let's hope that happens soon. I don't think we're going to be back in 2 or 3. If we do get to those rates, that means we have a bigger problem on our hands. But I think, rates in the high 4s to 5s, high 4s would be government loans and 5s would be, conventional jumbo, things like that. What are some fun stories? What's going on in the news? I went around, I searched this week, got us some good topics. I thought these are good stories, so let's dive into them. So CNBC says Gen Zers are willing to buy fixer-upper homes, some already regretting that decision. I always make this statement to people. I said, hey, if you're married, if you can get through a remodel, you can get through anything, because remodeling a home, buying a home is, okay, look, let's back to training. Getting pre-qualified, going through the motion of buying a home, it's stressful. Moving is stressful. It's just at the top of the stress list. You don't do it that often. You got to show your financials. You got to qualify. You're moving money over, all this. You got to move. It's this. You can't just do this and you're done. So it's a very stressful process. On top of that, you're going to move in and then, hey, I'm going to go redo the house. I'm going to get contractors. And even if you get great contractors, shit always happens. Over budget. You don't have enough money. The contractor didn't show up. They didn't do a good job. This vendor, that vendor, whatever. Cabinets are late. Where are my appliances? All these things happen when you remodel, especially your first one. You're going to learn a lot. And that's just the name of the game, folks. So if you are watching this and you're going to remodel a house, if you're going to buy and remodel and you think everything's going to go perfect and you're just like perfect, it never, ever, ever happens. There's people building these luxury homes with the best contractors. And I know a neighbor of mine is waiting 2 years for a garage door. Like what? You're like, what the hell are you doing with this garage door? It's crazy. So with that being said, let's jump in this article. Let's see What is going on in this article? Affordability barrier. 22% of Gen Zers find the lack of affordability starter homes a barrier to home ownership, prompting some to consider fixer-uppers. Willing to buy? 57% of Gen Zers are willing to buy fixer-uppers, but 27% of those who did already regret that decision due to unforeseen costs and challenges. Like I just mentioned, if you're going to buy a fixer-upper, you need to go into the mentality, get your family on the same page, you on the same page, that things are going to happen. Things are going to cost more. Things might cost less. Shit's going to not work out. Shit's going to work out. You're just going to have to get your head wrapped around. That is normal. That is reality. Cost savings and trade-offs. Fixer-uppers can save buyers about 29%, but that requires significant renovation costs and compromises. Expert warnings. Expert highlight the importance of understanding the true cost of renovations and repairs, which can overwhelm the first-time home buyer. Remember, I mentioned that. You think it costs this, it costs more. Especially with inflation and things gone up, it costs a lot more. Look, it's better than it was, but it costs a lot more to redo a home than 5 years ago. Even the insurance companies came out and said 5 years ago to repair and fix stuff, it's costing 31% more to do house repairs, things like that, than it was 5 years ago. Just think about that, 31%. So if you had a $100,000 remodel job, it's $130,000 more. Crazy. Safety and functionality. Buyers must ensure fixer-uppers are safe, functional, considering issues like asbestos, which is like crap in the, it could be on the walls, it could be in your attic, you know what I'm talking about, right? Asbestos, that stuff you do not want to inhale, breathe, you can get really sick. Electricity and overall land condition. Renovation costs. The median spend on renovations has increased, with 51% of homeowners spending $25,000 or more in 2023, often funded by savings or credit cards. Also, see, you're going into debt to do this. Inspection essentials. Key areas to inspect in fixer-uppers include the roof, plumbing, electricity, walls, stairs, and land condition to avoid unexpected repair costs and hazard. Absolutely. You also want to make sure the foundation of the structure, there's no crack slabs, is good to go, and that's really good. You want to camera the plumbing lines to make sure everything's good. So this is a huge thing. Look, fixer-uppers can be great. You can buy them, fix them up. You can have instant equity. You feel good about it. You do remodel it the way you want. Maybe you're moving walls, adding square footage, knocking things down. Maybe you're just doing the cosmetic stuff. But fixer-uppers, don't get scared about them. Just make sure you have a good team. Make sure you have extra money to go over, and make sure you give yourself extra time. And last but not least, sit down with you, your family, whoever's involved, and make sure you all understand that things are going to happen, good, bad, or other. Just make sure you all get through it and you understand that. What else is going on out there? CFPB proposes, Consumer Financial Protection Bureau, if you didn't know, proposes new servicing rules that would focus on foreclosure assistance. Pay attention. Here we go. CFPB proposal, a new rule to amend Regulation X, emphasizing borrower assistance over foreclosure, simplifying paperwork, and improving communication and accessible languages. Okay. Industry support. MBA and ABA praise the proposal for modernizing the loss mitigation framework and urge consideration of industry feedback. Key rule components. Revealing dual tracking, limiting fees, reducing paperwork, enhancing communication, offering multilingual notices. I love it. Positive feedback on flexible loss mitigation options during the COVID-19 need for permanent simplification. HPC endorsement. HPC supports updated, aligned Regulation X and improved government and GSE loss mitigation programs to prevent foreclosures. Basically, folks, what they're trying to do is they realize that whether it's short sales, foreclosures, you can't make the payment, mortgage companies, banks, lenders, companies that service the loans, they understand that they'd rather work with you. So if you have lost your job or your business and maybe you're like, hey, I need a break, I need a bridge, I need to get through this moment, they don't want to foreclose your short sale on their house. That is not the business they're in. So let's get that clear. They do not want to do that. It is a pain in the ass. What they want to do is make sure they give you a loan and you make your payments, and that's what you do. And if you can't do that, they want to try to start working with you to the best you can. If you are having problems paying your bills, and I don't care if it's a credit card, a car, a mortgage, the best thing you want to do is get on the phone, proactively. Let them know what's going on. Maybe they'll let you skip a payment and see if it will not affect your credit. Tell them you're going through challenges, but don't start missing payments and screwing up your credit before you talk to your credit card company, your car company, your home mortgage company, whatever it is. Make sure you talk to them, be proactive, be honest. You might be surprised how they can help you more than you think. So the Washington Post has an article out. Let's take a look at this. 5 reasons your financial advice does not work. Living at home. Maybe 20-somethings, especially in high-cost areas, live with their parents despite social expectations to live independently. Changing milestones. Compared to 40 years ago, young adults today are less likely to have a full-time job, be married, be financially independent, or live on their own by the age of 21. Come on, guys. Financial independent trends. In 2021, only 68% of 25-year-olds lived independently, down from 84% in 1980, reflecting changing economic conditions and priorities. 68, so that's a big difference. It's almost, it's like a 24% difference of more people, younger people are living at home. I get it. It's just the way our society has evolved. Advice on home buying. While some advocates for buying homes early and renting out rooms, this may not be feasible due to financial instability, economic downturns, and high cost of living. I agree. Maybe you can't buy a home. Maybe you're over your skis. Make sure if you are buying your first home, you are prepared. You went through everything. You can afford it. Obviously, if you're young and single, go get roommates. Go rent out your rooms. Buy house hack, whatever you can do. But if you can get in there and buy a house sooner than later, it's good for everything, for your psyche, to have your own place, for tax benefits, and also for future, for equity gain. Economic struggles for Gen Z. Young adults today face higher consumer prices, making traditional loan hard to achieve. Some costs stopping from buying are housing costs, high rent, car insurance, student loan debt. Interesting. Could the equity in our housing help a downturn in the market, a sell-off, a crash, whatever you want to call it? Could it? Let's take a look at the facts and see. In this Housing Wire article, the financial strength of U.S. homeowners is a cushion against a downturn. Remember, the homeowner that's in there is dealing with inflation much different than a renter, because if the homeowner in there refied at a 2-3% rate, they're not feeling as much pinch because they get the nice low fixed payment. They're like, life is great, but other stuff is higher, but it's not like they've been renting and it's gone up and up and up. Home equity. Only 0.3% of homeowners have negative equity, with the national loan to value ratio improving at 48.3, providing a strong financial buffer. Low mortgage rates. 76% of homeowners have mortgage rates below 5%. That number's higher, with 21.9% under 3, enhancing their financial stability. Stable market, low inventory levels, maintain market stability despite higher mortgage rates. Economic resilience, home equity, and favorable mortgage conditions reduce foreclosure risk, even with potential unemployment rises. And last but not least, supportive policies. Pandemic-era policies ease access to loss mitigation options, reinforcing homeownership financial stability. That is true. For this week, that is it. Thank you for watching. Please share this with somebody. Obviously, every week we go over what's going on in the market. I bring in some fun articles, some data, some facts of what's going on out there with first-time home buyers, some personal finance stuff, how you're managing your money, how you should do this, that, all these articles, all these fun authors to share. Thank you so much for watching. Remember, like, share, comment, whatever you got to do. And if you have questions and you're not reaching out to me, shame on you. Just kidding. But look, if you guys have questions, you have a scenario, you want to go through something, reach out to me. You'd be surprised at how many questions I get in a week that deal with real estate investor or real estate investing or insurance or rate quotes or can you do this or advice on this. So reach out if you have any real estate questions. We are here to help. Thank you so much. Have a great week. We'll talk to you soon.